In this video, I'm going to talk about NPV versus IRR rule when we want to choose among mutually exclusive projects. So, as we already know, the NPV rule when we want to choose among mutually exclusive project is to choose the project with the highest NPV. However, the IRR rule says that if you want to choose between mutually exclusive projects, you should choose the project with the highest IRR. So, for example, if we have two projects A and B, and their IRR are IRR A and IRR B, let's say that IRR A is bigger than the IRR for project B. So in this case, the IRR rule says we should pick the project A, not project B. However, you should know that we should avoid using IRR rule for choosing among project because picking the investment opportunity with the largest IRR can lead to a mistake. It doesn't always give us the best project available. We always need to stick with the NPV rule. Okay. So in the remainder of the video, I'm going to show you two examples in which IRR rule give us a wrong answer. So the first example is related to differences in scales. So using IRR can be misleading if projects have different scales. So what do I mean by that? One project might need $1 million investment. The other one might need $10 million investments. IRR usually does not work very well when there is differences in scales. Why? Let's consider this example. So which one do you prefer? 200% return on $10 or 10% return on $10,000. So I'm going to call the first one project A and the second one project B. So essentially the IRR for project A is 200% and the IRR for project B is only 10%. But 200% on $10 would give us $20 in return. So essentially, I can multiply 10 by 3 to get 30. So including my initial amount of investment, the return and my initial investment for project A would be $30. But if I want to calculate the same thing for project B, 10% of $10,000 is $1,000. So if I multiply $10,000 by 1.1, I would get $11,000. Okay, so the point here is that because of the differences in scale, we definitely would prefer to have the second option, 10% on $10,000, not 200% on $10. But IRR does not recognize the scale in projects, so using IRR would lead to a mistake. Okay, so as I said, the higher IRR does not always indicate the better project. However, notice that NPV rule does not have this problem, because in the NPV rule, we are comparing cash flows, and cash flows show the scale of project. So when we are in the NPV, we are calculating the present value of cash flows. We are considering the scale of project, and we are choosing the project that gives us the highest NPV, which directly translate to amount of cash flows. So now let's talk about the second example. IRR is also sensitive to timing of the cash flows, but this sensitivity is not similar to the sensitivity of NPV. So what I mean is that uh, to calculate NPV for a project, we also take into account the time value of money, and we calculate the present value of each of the cash flows to calculate NPV. But what I'm talking here in IRR, the timing of cash flows is important. For example, how much you are getting back at the end of year one versus how much you are getting back at the end of year three might be important. Okay, so let's calculate NPV and IRR for these two projects, A and B, that are listed in here. You can see their timeline. So I'm going to calculate their both NPV and IRR, and I'm going to compare the decisions by the NPV rule and the IRR rule. And to calculate NPV, I will assume that the cost of capital for both of these projects are 10%. Okay, so project A, NPV is $24,192, but for project B, NPV is 27,723, which is bigger than project A. So using NPV rule, I should choose project B. However, if you look at the IRRs for these two projects, the IRR for project A is 26.44%, which is higher than 24.69 percent, which is the IRR of project B. So if we use the IRR rule would actually say to choose project A. So this is with the IRR rule, and with NPV, we already see that we should choose project B. So here the IRR rule disagree with the NPV rule, and as we already talk about this, we always need to rely on the NPV rule. So here's a description why this is happening. Project A pay back the initial investment quicker than project B. So again, see here that we have larger cash flows upfront for project A versus project B, and then project B has some larger cash flows at the end of the year, end of the life of the project. So here, what I was talking about, the sensitivity of IRR to the timing of cash flows. Okay, so IRR can give us a misleading answer because it's sensitive to timing of cash flows. However, as we already saw, the NPV of project B is larger, so we need to choose project B. So using IRR in this example would have give us a wrong answer. Again, to sum up, we always need to stick with the NPV rule.